You ever look at some huge company, a tech giant, or even just your favorite coffee shop down the street and think, what's that actually worth? I'm not talking about the stock price you see on the news. I mean, what is its real, fundamental value? Well, that's exactly what we're going to get into. I mean, it's a massive question, right? How do you actually put a price tag on a whole business? Is it the buildings it owns, the money it makes? What about its brand, its potential? How in the world do you wrangle all of that chaos and spit out a single solid number? Honestly, it sounds kind of impossible. But for decades, this is exactly what finance pros have been doing. And the secret is a powerful tool set called financial modeling. It's basically a way to translate a company's entire story, all its moving parts, into the language of numbers to figure out what it's truly worth. So, to really get how we value companies today, we've got to rewind. We have to go back to the very beginning to one single revolutionary idea that pretty much changed everything. So, back in the 1960s, we get this thing called the capital asset pricing model, or CAPM for short. And its genius was just how simple it was. It basically said, look, you can figure out a stock's expected return by looking at just one thing, how much it moves with the overall market. They called this its beta. But there was a problem. As people gathered more and more data, they realized CAPM couldn't explain everything they were seeing. Sure, market risk was a big piece of the puzzle, but there were clearly other things going on that the model was just completely blind to. It was incomplete. And this is where the thinking had to evolve. So in the 90s, two researchers, Eugene Fama and Kenneth French, came along and built on that original idea. They said, okay, let's keep market risk from CAPM, but let's add two more crucial factors. As you can see here, they added company size and what's called book-to-market value. Why? Because their research showed that, historically, smaller companies and so-called value companies just performed better. And this wasn't just some abstract theory. The data backed it up, big time. Study after study showed that the Fama-French model was way better at explaining what was actually happening with stock returns in the real world. It was this huge leap forward, proving that value wasn't just about one thing, it was about many things. All right, so that's the academic backstory, but what about the people in the trenches? How do investment bankers and analysts actually use these ideas to slap a number on a company? Well, their go-to method is something called the discounted cash flow model, or DCF. Let me tell you, this is the absolute workhorse of modern finance. If you're in that world, you live and breathe DCF. And its whole goal is to figure out a company's deep, intrinsic value based on all the cash it's expected to make in the future. The concept behind it is actually really intuitive. Just think about valuing a fruit tree. A DCF doesn't care what the tree's wood is worth today. No, it values the tree based on all the fruit it's going to produce for years and years to come. The only tricky part is figuring out what all that future fruit is worth in today's money. And that whole process really boils down to four main steps. First, you have to predict how much cash the business is going to generate over, say, the next 5 or 10 years. Second, you figure out a discount rate to bring those future dollars back to their value today. Third, and this is a big one, you estimate the company's value for all the years after your forecast ends. And finally, you just add it all up. Simple, right? Now, that discount rate from step 2, it has a fancy name, the weighted average cost of capital, or WACC. Just think of it as the blended interest rate a company pays for all the money it uses, whether that money comes from lenders or from shareholders. The higher the risk, the higher the WACC. Okay, now this is where things get, well, a little bit crazy. That terminal value we just mentioned, the part that's supposed to capture a company's value forever into the future, it is unbelievably powerful. Get this, it often makes up more than 75% of the company's total calculated value. 75%. That means if you just slightly tweak your assumption for its long-term growth, the final number can swing wildly. It's a huge deal. And because it's so sensitive, even tiny mistakes can have massive consequences. One of the most common errors you see is someone accidentally grabbing historical data when they're trying to project the future. It sounds so basic, but one wrong cell in a giant spreadsheet can literally inflate a company's valuation by millions of dollars. So the fix, the thing you have to burn into your brain, is this core principle. The past is the past. What a company has already done is history. It doesn't create new value. A company is only worth what it's going to earn from this point forward. That's it. Only future cash matters. So, you can see how we've gone from these simple one-factor ideas to these incredibly detailed, complex spreadsheets. But the story doesn't end there. The evolution is not stopping. In fact, the next giant leap in valuation is happening right now. You see, for as powerful as a DCF is, it still has limits. These traditional models really struggle to capture the messy, chaotic, and totally non-linear ways that markets actually behave. And this is exactly the kind of problem that artificial intelligence and machine learning were built to attack. AI is just a total game changer here because it can see patterns that humans in our spreadsheets just can't. It can find these super subtle connections between hundreds of different variables. And it can analyze huge amounts of unstructured, what we call alternative data. I'm talking about things like the tone of social media posts or even satellite photos of retail parking lots to get a live, real-time read on how a business is doing. And the results? Well, they speak for themselves. This table here compares the performance of a few different types of machine learning models. And you can see a pretty clear pattern, right? As the models get more sophisticated, as we move toward deep neural networks and transformers, they just keep getting better, delivering higher returns and better performance for the amount of risk taken. That's what that Sharpe ratio is all about. This chart really drives the point home. That transformer model, which, by the way, is the same kind of tech behind things like ChatGPT, is leading the pack, pulling in annual returns of over 20%. And the reason is likely because its design is just exceptionally good at understanding context and seeing long-term patterns in financial data, something the older models really struggle with. But it's not just about hitting home runs. It's also about being consistent. One study found that AI strategies that can actually recognize and adapt to changing market conditions, what they call regime awareness, were profitable in 80% of the years they looked at. That level of consistency is just incredible. So when you step back and look at the whole journey, it's pretty amazing. We started with this clean, simple idea about risk. Then we moved to these sprawling spreadsheets trying to predict a decade of cash. And now we're at the doorstep of self-learning algorithms that are crunching unimaginable amounts of data to find an edge. But through all of that, the fundamental goal has never really changed. We're all still trying to answer that very first question. What is a company actually worth? What's changed, and what's changing so fast, are the tools we use. From a single formula to intelligent algorithms, our methods for finding that answer are just getting exponentially smarter. And all of this leads us to one last, really fascinating question. As these AI models get better and better, as they get more accurate at predicting a company's true value, what happens to the human analyst? What is our role in a world where the machine might just have the better answer?